Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 27th, 2015. I wanted to do a quick overview on the markets and some of the things that I'm watching right now. Trade ideas on the site have been, individual trade ideas have been on the light side lately. I've been extremely preoccupied, working on some back end changes on the site. But with that being said, I've put a lot of my focus a lot of my efforts into just trading keeping it simple right now, trading the indexes, QQQs primarily, and gold and the gold mining stocks, along with a couple other miscellaneous things. So today we'll just take a look at the U.S. Indices as well as gold, take a look at the near-term and long-term outlook. I'll try to keep this video as short as possible. Um, well, starting out here, we're looking at a chart. This is a 15-minute chart of the Qs, chart that I've posted quite a bit lately. That's been up on the site. I'm sure most of you have seen this. I did have a question. A few days ago, somebody asked me why the Qs, why QQQ, why not pick an energy-heavy weighted index like the SPY? And my response to that email and it had to do in large part with the fact other than I have a little bit of better read on the QQQ chart right now, is the fact that I'm more bullish on energy stocks at this point. They've already had a tremendous washout. As I made a case back a few months ago, I said that oil was probably very close to a bottom, and I still believe that to be true. It doesn't mean we're going to rocket right up. We've come back and retested, made a new low, but then oil has been very strong lately. So, again, all my posts are there. I've been bullish commodities, bearish, at least looking for a pullback in the dollar, which obviously has started to manifest here. And I'll talk on a little bit more on commodities and the dollar in a separate post. So I just wanted to make clear why the QQQs I believe have a little more downside than the S&P 500, and that is because of the heavy energy weighting in the S&P 500. I think those stocks are pretty much washed out for the most part, with more upside potential than downside at this point, in my opinion. So with that being said, this is the QQQ 15-minute chart. These are some of the sell signals we had. I put the heaviest weighting on this break of dual support. I talked about that ad nauseum, that 108 horizontal support level, and the uptrend line here. We broke down, as I pointed out, and as was forecasted, we would have impulsive selling, and that helps to validate that these support levels were indeed well watched by many traders. As you can see, the very impulsive selling, and of course a reason that I love to short stocks just as much as going long. The profits can be very fast. Stocks tend to fall much faster than they rise. Overall during corrections. So that was sell signal number one, as I mentioned. Sell signal number two down here I've talked about. I believe at the time I was looking at the 30-minute time frame, but the same typically holds true on the 15-minute time frame we're looking at here, and that is to see the signal line, the 9 EMA on the MACD. Typically, when that crosses below zero, that confirms at least on the time frame we're talking about here. So a 15-minute time frame, I refer to that as a shorter term time frame. So these are short-term time signals. You can just go back in time, and when you see the MACD below the zero line, for those of you not familiar with it, the zero line here is the dotted line in the middle of the MACD. So that helps us define trends. So as you can see, when the Qs from this point on, back on around the 15th or so, we were in a nice uptrend, and as you can see, the MACD was above the zero line, and it also found support on this little pullback here. The MACD found support, just as if when it's below the zero line, you often see tests from below. I don't know if you can see under this note here. You often find the MACD rejected as the zero line working as resistance. So again, just one of many tools, not a standalone buy and sell indicator. As I often say, there is no one true standalone buy and sell indicator that's 100% effective. But when you take all these things in context, the more sell signals you have to confirm a short entry, the higher probability you have of that trade playing out. So we had the MACD sell signal, as I mentioned, which I expected after that, which confirmed shortly after. We had this again on the earlier. I was using a 30-minute time frame, and on that I pointed out I like a 14. I have various exponential moving average pairs that I use. This is a custom histogram that I created, and on the 30-minute time frame that used a 14 and a 34 EMA. Being that we're looking at a 15-minute chart here, what I had to do is double each moving average, and that gives you the same, essentially the same moving average pair. In other words, a 2868 moving average pair on a 15-minute chart is the same as a 1434 because you're just doubling the time period there. So, and as you can see, it does a really good job of helping define these short-term trends when that pair is in negative territory. In other words, this histogram simply shows that the 28 day moving average, or 28 period, I'm sorry, not day, 28 period on a 15-minute period chart. When that moving average is below the 68, you're on a sell signal. And the trend, as you can see above, is clearly bearish. And when you cross over, that's a buy signal, confirmed here, confirmed shortly after by the MACD, and we had a nice uptrend. So simple. And again, these are just so, multiple tools, 1, 2, 3. We're looking at least 3 sell signals that got us in pretty early here. And even though the Qs were officially a short before that, because I had a very very strong opinion that we were going to break down. So we had a short earlier. We hit our downside targets on the earlier previous QQQ short-term trade, and I used my preference for that was SQQQ because it was a short-term trade, and we hit both downside targets, including the final short-term target. And then I also had a longer term swing trade, which was taken out, and then I reshorted shortly after that trade was stopped out on the official criteria. So that's where we're at. And the other day, as I mentioned, I expected a reaction here. Typically, I expect reactions on each support or target level. These are short term. When I put S1, S2, S3, that's just support 1, support 2, support zone 3. And we did slice through the first support level pretty much as if it wasn't there. Not surprising. I did mention once we broke below here, I expected to see the selling kick in impulsively, and that's what happened. And sometimes when you have impulsive selling or buying, works in reverse. You tend to smash through resistance levels, and on support, on down moves, you can smash through support. So that's what we did. And then we hit S2. And, I often define a reaction. I expect reactions off these levels. And reactions, I always use one of two terms, either a consolidation and or a bounce. And this was more of a consolidation. I took a pot shot. I covered my short here. Took a pot shot at a bounce long, fell shy of my target, but as stated, I was going to give it a little room below S3, which it did. We consolidated there quite a bit, and then couldn't really manage to rally a bounce off S2. So we broke through, had a little washout move here. The reason I always have my stops and give it a little room, especially during a very strong up or down trend, is because momentum tends to carry a position and slice through a support level, even if that support level is going to hold. So in this case, I consider that being held. Other people might say, well, no, look, we went below S3, let's measure this out. If you look in the left-hand corner, we went through there by a 0.5%. So very little margin of error. And considering the velocity or the momentum on the downside, that's really not bad. So where we're at, again, I expect a little more upside. I'm doing this video pre-market right now, and let's see, the Qs look to be about flat. We're trading at 105.03. We closed at 105.12 yesterday. So we're looking, as I do this, a few minutes before the open, about a flat open. And, as long as we don't take out these lows, undercut these recent lows from the other day, I think we're okay. And I think there's a good shot for a move up to at least this 106 area, somewhere there, maybe a little bit shy. Yeah, about 106 or so. And I would not be surprised to see us come all the way up to this 107 move, either today or early next week. So I'll talk a little bit more on my plans as the day unwinds, whether or not I'll take any positions home, or if I do go home, whether it'll be long or short. Okay, moving a little faster. Let's zoom out here to the daily chart. This is a QQQ daily chart. This is a little different from some of the daily charts I've been posting on the site. I'm using stockcharts.com because I can provide a live chart link to that, which is easier for you guys to go in and check the charts. Since any of these static posts here, TC2000, this charting platform, unfortunately does not provide the ability to link to a live annotated chart. So I have to use static charts, but it is my preferred go-to charting platform. Much more user-friendly than stock charts, in my opinion. So that's what I'm using the video on, and what we're looking at here. This defines the top of the rising wedge. This is the same rising wedge I've been pointing out for weeks now. This white line was the bottom of the rising wedge. So we did break through support, as I mentioned the other day. Once we took out that what was it, S2 level, I think, on the 15-minute chart, that would have taken us below, which it did. I have an alternative trend line. Let me zoom in here. I know you're watching this on YouTube. It's not too big. So the white trend line was the one that I had before. And I still think that's a valid trend line, and we did break below there. However, I added this yellow uptrend line recently. I was considering this all along because we had this reaction low. If you look at that candlestick wick back here, that's from February 2nd. So if you look at the wick or tail on that candlestick, the shadow, I should say, or tail, that's February 2nd, and there's a tag there. So we had this first tag and now another tag. So that is an alternative trend line that others might be watching. And again, in trading, it's about recognizing what other traders might recognize, because especially I've noticed this. It's strong or in those upward grinding moves that we've had in the last few years, especially when indices are breaking to new highs. Technicals are not as important. Yes, traders do buy pullbacks to certain moving averages and whatnot, but there's no overhead resistance as the market's making new highs. However, it's been my experience during corrective phases, technical analysis tends to work a lot better. Everybody's, even the pros that might normally stay long and aren't active traders, they're watching those levels and buying at support or selling breaks of support, etc. So again, this may be a level others are watching, so that's something to take note of. And it also coincides with that horizontal support level that I just talked about on the 15 and 30-minute charts. And so one possibility here would be a back test of this white wedge, which I still give a little more, I'll call it validity to. But ultimately, and I've talked about this yellow downtrend line. Let me just click out to a 2-day time frame on this chart. This goes back 4 years. So this is a trend line that's almost 4 years long, this yellow trend line. We're going to go back to a daily time frame, and that's my target. And I've pointed out this target, even when the Qs were way up here, I maintain this target. Here's a horizontal line. I put it April 23rd, and this is just indicating to me what I'm looking at is that long-term uptrend line, as well as this horizontal support level here that's just a little bit above 100. I'm sorry, a little bit below 100. To me, that is a magnet for the Qs, not just because there's an intersecting support level, but because of everything that I've mentioned the last few weeks. Divergent tops, bearish rising wedge pattern. I've talked about when I initiated the original short entry here that we had some extremes on the sentiment readings, very rare extremes. So a lot goes into this other than just, hey, there's a couple support levels below. That means we're going to go there. And I tend, when you see two solid support levels like this, very often you'll see prices come in together. So again, that my expectation is stated for weeks now is that the Qs will come down to the $100 area on or before April 23rd there. So we could easily hit it before. We may come down and just hit this horizontal line. We could skate around. Ultimately, I do think we'll hit this trend line as well, even if we hit that horizontal level first. So either way, that's my longer term target. Divergences are there in place. And finally, to take a look at the really big picture, we zoom out here to a weekly chart. This is a 10-year period. Here's the bear market back from '07 to March 2009. Actually, the Qs bottomed a little bit before the rest of the market back in November, but most U.S. indices was March of 2009. That's where the bull market kicked off. So that's where this trend line originates. And you can see there's a lot of tags on this trend line. This is a very well-defined trend line. I've been pointing out for months this is almost an unnatural, very low volatility grind, just hugging that trend line. This is the big fake out that got me back here. I thought this was really going to kick off some big selling. We had um, a weekly intra-week breakdown, and I did point that out. The SPY actually closed below their uptrend line. The S&P 500 and most other U.S. indices, however, it was pointed out at the time the Q was the only index, the Nasdaq 100, that did not print a weekly close. And as I always talk about, if I'm trading a weekly time frame, in other words, we're looking at a weekly time frame, time frame here with an uptrend line, you need to see a weekly close, candlestick close, because these little intra-week breakthroughs, this candlestick tail, those are relatively common. So again, we have not had, at least on via this trend line, a true long-term sell signal yet. But as you can see here, divergent high. This is the PPO, the RSI, very steep divergence on the RSI. It's not really drawn up top here. You'd have to put the upper line, but as you can see, weekly divergence in place, and even on the volume, if you look here, if I drew a downtrend line. So that's the Qs. Longer term picture is still bearish. I made whatever you call it, a statement in the earlier in the year, early in January, that I expected U.S. equities to underperform commodities in 2015, and I still believe that to be the case. I still think there's going to be one doozy of a correction some point this year, and right now the charts are what I call stacked. By stacked, I mean if the shorter term patterns that I've talked about play out, this would bring the Qs down again to at least 100. That's my preferred target right now, my minimum target, but I do have some additional downside targets. So if and when this multi-year uptrend line is broken and the Qs move well below that $100 level, what that does to this weekly chart, if we look here, is also bring it under that multi-year uptrend line. So there's that 100 level. If we go down there, if we hit my chart on the my target on the daily time frame, that is almost certainly going to trigger some longer term sell signals, such as a break of this uptrend line. So that's what I mean by the chart is stacked. Charts are stacked. That's like a domino effect, if you will. Okay, too much time spent on the Qs, really. Again, those have been covered ad nauseum in static posts lately. Here's the SPY real quick. This is an uptrend line to watch. We're looking at, the daily chart of the SPY. Prices have just ever so slightly pierced below that uptrend line. So, yesterday, at least we had a spike through and a close below, and we're looking at prices still trading just below, but by only by the slightest margin. So a fake out is still possible. But again, as I mentioned on the QQQs not so long ago, these wedges, just like the QQQ rising wedge on the daily chart, are really at the point where they typically break down, which is give or take around 70% to the apex of the wedge. So we're at that point where if they are going to break down, they probably will, and they have. So there's a very good shot we may keep going, and if that's the case, I'll be right back into that short position. On the way down to my longer term targets. So that's a daily chart of the SPY. These are just other trend lines and things that have happened in the past. This was a long term trend line. This was that big breakdown I talked about on the weekly chart where the SPY actually printed a weekly close, and that looked like the real deal. I mean, very solid trend line, multiple tags, and that was one of just one more in a long line of fake outs in this Fed induced Fed manipulated market in the last several years. But here's a weekly chart of the SPY. Let's actually see if I can get a better. Okay, with this chart, I haven't mocked this one up. Maybe a S&P 500 might be a little bit better to look at. I might have some clearer notes on there. Hold on once. Okay, this one's pretty clean. All right, I have a lot of different drawing boards with many different annotations. So this is really the big picture on the S&P 500. Here's a 10-year weekly chart. These are the lows back in March of '09. This is our bull market uptrend line. This is, we have these tags here, tag back there. There was that weekly break. This trend line's been adjusted to really show that us closing back above there. There's nothing wrong with adjusting trend lines. In fact, as time goes on, you need to make adjustments. So along the way, there have been these minor uptrend line breaks, and each one was followed by a very, sizable correction. Doesn't look like it on this scale. I'm using a log scale, but there's a big picture. We're just wedging higher, wedging up, prices contracting, momentum is definitely waning, and strong divergences in place on both the RSI, the PPO here, and some other indicators you might look at. So again, if this correction plays out, continues, markets continue to go down, we're going to break these longer term trend lines and generate some longer term sell signals. Most of my longer term and even my intermediate term trend indicators are still fine. Those are solidly on buy signals, so I'm not getting too excited right now about a huge wash down move. I think we can trade this thing down on the way. Probably looking to cover my short maybe at the 100 level on the QQQ. And very soon on the site, I'll try to get some individual names out there because, as most of you know, have been following the site, if we get a correction, even if the market drops 5%, most of my individual short picks are going down 10 to 20 plus percent because I like to sniff out the most bearish looking patterns. When you short the whole market, you're shorting the good and the bad. You short the S&P 500, well, you're shorting energy, utilities, healthcare, defensive stocks, everything out there. So there's always going to be, the good holding up the bad during a bear market. Okay, and this video went a little bit longer than I anticipated. So what I'll do is I'll do a separate either video or static update on the gold stocks. But again, there's not a whole lot that I haven't already discussed. So I just wanted to get this video out there for those of you that trade the broad markets. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.